Hello and welcome to This is Property with John Pidgeon and, of course, Rachel from Sphere Home Loans. Welcome, Rachel.
Thank you.
Back to basics today, finding the right investment property, whether that be your first or just the right one. We want to make it right, don't we? So we're going to break down what makes a good, solid, hearty investment property. Right. And if you haven't seen it, Sort Your Property Out and Build Your Future by myself. We'll put the link in the show notes, but that does go through a very elaborate 8-point strategy that I use personally for our clients. So we can thrash a little bit of that out. Really keen to get your lending eye over it as well as your investment experience into this topic as well. So let's get into it. This episode is brought to you by Terry Shear, Australia's leading landlord insurance specialist. Whether it's damage caused by tenants, pets or loss of rent, their expert cover gives landlords peace of mind. With over 250,000 properties insured and a customer-first approach, they know what matters most when things go wrong. Find out more at terryshear.com.au. And remember, before buying this insurance issued by Terry Shear, read the PDS and TMD and consider whether it's right for you. See the website for a copy. Limits and exclusions do apply. Rachel, we've got a real life story, haven't we?
We
of a listener, and they want to remain anonymous, so we appreciate and respect that. They've got an investment property, so don't just take it from us because we can only tell you so much and share our experiences. But here's a real life story from Anonymous. Let's call him Phil.
Let's call him Phil.
Yeah.
I'll just find this on my phone.
I entered the property market in 2021 and the main wins include after 9 months of unsuccessful bids, I became the owner-occupier of a 2-bed, 1-bath, 2-garage apartment. Thanks to the strategy my team devised, including an awesome broker, property coach and accountant, I have the flexibility to live in a property I love, lease out the second bedroom and given its coastal location, also have Airbnb options. It also caters to my future goals to settle down and buy a home with my partner, as we can rent-vest in future when we combine our incomes to speed up saving goals for a family home one day. What I would do again? Build a great team of experts well before making any offers. And also you can never do too much research, namely rental appraisals, council zoning for insights into the future landscape, flood zoning maps, pest and building reports, strata reports and AGM minutes when applicable. Also, make contact with real estate agents and get on their database so they can send you off-market opportunities. It's a good chance to secure something under market value if an agent knows exactly what you want and knows you have all approvals sorted. Finally, things I would do differently, except that errors will be made when it comes to managing conversations with some real estate agents, although any opportunity missed serves as a useful lesson for future properties. Don't be afraid to walk away, period. There will always be another property out there. Don't be scared of traditional auctions or silent auctions, and don't be too fixated on private treaties like I did. It doesn't change anything if a bid is placed via email for a private treaty or in person at an auction. After securing my apartment at auction, which was scary at the time, I now have no issue in bidding at future auctions. It's nothing to be afraid of. And finally, accept that no property will tick every single box. Don't be emotionally attached or too picky. Focus on properties that tick the boxes of core requirements for your strategy to work, and focus on the bones of the property. I would rather add value through repairs and renos myself over time when I can afford it in return for a lower sale price.
There we have it. That guy is switched on.
Very switched on.
Isn't he? Very happy with his purchase, obviously. We look at 3 things when we're talking to clients: buy at discount, add some value and capital growth. He has secured all 3 of those, hasn't he?
Yeah, he has.
He thought about the discount on the way in. He spoke to agents trying to get off-market or early market listings and know what something's worth. Adding value through cosmetics.
Yep.
Right. And then obviously capital growth. He did buy in a good location, coastal area.
Yep.
And people might be listening in, long-term listeners of mine, and saying, well, John, 2, 2 and 1, that's normally what you don't endorse. But they've got to be niche, don't they?
They
Right?
do.
So that this wasn't just any old 2, 2 and 1. coastal location, blue chip, and small complex. So I wouldn't even call it an apartment. I'd probably more call it a unit. But that's either. What was your thoughts on that?
Yeah, well, I remember when he was looking, and it was between owner occupied and investment. Wasn't quite sure what to do, but from the sounds of that, he's actually done the two. So he's living in it. So he gets the luxury of living in that property, but also renting out a room.
Yeah, smart.
But knowing that he can use that same apartment, knowing it's going to be prime for Airbnb when he does move in with his partner down the track and buy a forever home.
Yeah, it's a nice stepping stone. And he realised, obviously, that it wasn't going to be his forever home. And I suppose today's topic of how to buy the best investment property might actually be, in his case, an owner-occupier first, because it just worked. It aligned with what he was doing at the time.
Yeah.
And, of course, as first homeowner, concessions around the country at the minute. And if the shoe fits, that's pretty cool as well, isn't it?
Yeah, that's right.
I took a few things away from that. One, finance approval.
Yeah.
Right in your wheelhouse, making sure that you're really solid with your finance before you go all guns blazing, putting in offers or talking to agents. It's a really critical one that's often overlooked, isn't it?
It is. And agents know whether they're going to take you seriously or not by the language that you use.
Yeah.
And I feel like the agents really know if you're someone who's done the work before you're coming in and negotiating.
Yeah, absolutely. Team of people. He had that in droves. Present company excluded. But, he had a really good team of people around him, and he knew who to source to be able to get the job done.
That's right.
And that's really important, whether you're project managing a renovation or you're, forming a football team or whatever. You need a good team of people wherever you look in life.
You do.
Yeah. I wrote down strategy. He knew what he wanted. He knew the location, he knew the property, he knew not necessarily what the property was going to buy, but he knew what he was after, and he went really hard and fast at that.
Yeah, absolutely.
And the other part of it, which is interesting but sort of weird at the same time, is non-emotional. So you're buying your own home to live in, but he was not emotional about it. He said, well, it's another good deal every other day of the week.
Yeah, I loved it when he said, don't be afraid to walk away.
Yeah, that's a really good key part of being a good investor, I reckon.
Yep.
Is you walk away, there's another one next week, isn't there?
Yep.
Yeah.
Always another property.
Always another property. There's thousands of them around the country. So, yeah, that was very good. Awesome little story there. So let's get into a few questions.
So the first question I can see is, should I buy a house or a unit for my first investment? Which really, brings into that scenario we just read out as well.
Yeah, and generally my answer to that would be land goes up in value. So let's try and capture some of that.
Yeah. Where I guess the one that we just listened to, though, that was a unit, but in a very prime location. So I guess there are exceptions to that as well.
That's right. And if that had have been a 1-bedroom, 1-bath, no car space, very different to a 2-2-1 that he bought.
That's right.
Yeah. So I think, generally speaking, I would say if we can get ourselves a house, every day of the week we would do that, wouldn't we?
Yeah, absolutely.
Units work, but they've just got to be more, I think, niche. And what's going to set this unit apart from everything else in the location or around the country, what I would be looking at anyway.
Yeah, and is there potential, if you are buying a unit, that there's going to be too many of those types of units too?
Yeah, so scarcity.
Yeah.
Yeah, absolutely. Yeah. All right, cool. How much deposit do I really need to get started as an investor? Because the old school has a very different answer to the new school.
It does. And investment is very different to if you're buying to live in. Because if you are buying your first property as an investor, you don't have those different things available to you like stamp duty concession or any sort of government incentives. So you really need to have that deposit saved unless you've got some sort of family help or something else going on. So I guess it used to be 20% that people used to say, but I think that's really now more like 10%. So you need a 10% deposit as a general rule of thumb, plus any costs like stamp duty.
So do you reckon of the people that walk through your door to get a home loan, how many of them would be coming through saying, I want 20%, I want to put down 20%?
If it was their first investment property and they don't have any other properties, I would say it was quite rare.
Yeah.
I would say less than 15% would actually come in with a 20% deposit unless they've had family money given to them.
Yeah, okay. Owner-occupier?
A lot less.
Yeah.
So you need a lot less to get in as an owner-occupier because, as long as you qualify for all those, those schemes that are out there and the stamp duty concessions, you could need as little as 5%.
5% deposit, yeah, which is really contradictory on the old school thinking, isn't it? Well, I need 20% to get into my own home because my own home's bad debt, so I need a large cash deposit. But now we're saying, hang on a minute, we don't need 20%. We appreciate the bad debt thing, but we need to get into the market sooner rather than later. So let's get 5% together and loan the 95 and make sure we can handle the repayments.
Yeah, there's a few people that miss out on that though, and they're the people that sometimes if the income's a little too high, and I feel like there's this group of people at the moment that are having a really tough time, and those people make a little bit more. So, if your income's over that threshold for being able to get the government scheme, but you're still paying a premium rent. It's really hard to save that deposit. So there's those people that aren't qualifying, that, they might be on a little bit bigger income, renting, in a city, but they still can't get that deposit together. So there's some great benefits if you are able to get those government incentives and lower that deposit, if it's to live in.
And for our long-term listeners, we are going a bit back to basics today, but the fundamentals are still the same. But understanding in the finance world, things do change quite often, don't they? Like the 5% deposit, I don't feel as though that's been around that long. Like not so much the fact that I can get 5%, but the fact that it's actually okay.
Yeah. Yeah, 100%. I think it's been around for a while, but I think people it's more well known now that you don't need quite as much deposit.
Yeah.
And a lot of the time that creates a stepping stone effect where you might not have the deposit to get into an owner-occupied. You want to buy an investment, but deposit's the thing stopping you investing. So you actually have to buy your first investment property somewhere close to where you live so you can live in it for a period of time. So then to make it an investment property, to get those schemes, you have to live in it first.
Yeah, that's right. Okay, so next question, and this is, again, directed to you because you're the expert in this space. Interest only or principal and interest? Which is better for an investment loan? Like when you're talking to clients about loan structure, are you recommending to them, I know you can't give financial advice, but are you saying, well, look, interest only is going to cost you $3,000 a month, principal and interest is going to cost you $3,500 a month, but you're going to save 0.2% interest, which one's going to be better for you, or let them make the decision?
It's always giving the options and let them make the decision. However, I would say most investors choose interest only on investment properties. And the reason for that is only the interest is tax deductible.
Yes.
So when you're paying principal on an investment property, that's not tax deductible, just the interest portion is. There's also the thing that generally you're going to have an owner-occupied loan, if not now, at some point, and you want all of your extra money that you would be paying on the principal to be free, to go into that home that's going to be your non-tax deductible debt at some point, if not now. So I would say interest only is the main way that people pay investment. Now, there was a period of time, maybe 5 years ago, where interest only loans became a lot more expensive. And that was probably the only time that I would have had at least half of our investors say, we're actually going to pay principal and interest because the rate difference is too big for us to say that. And you remember that time?
Yeah, and we're doing the numbers with clients over a 5-year period, for example, because a lot of interest-only periods are 5 years, aren't they? So we'd look at a 5-year period and look at the end result with the interest rate gap that there was. It was like 0.5% or more, like 0.7, 0.8 in some cases. And you'd think, hang on a minute, this is a no-brainer. You're paying P&I. I've got to actually flip my mindset because it's always been in interest-only mode, save your cash for a rainy day, owner-occupied deposit, etc. You've just got to look at the numbers.
Yeah, and that's something that has changed. And so that gap is a lot smaller now. So if you are an investor and you are paying principal and interest because of those reasons, it's time to have a look at that now.
So talk about the gap just briefly. Like, are you thinking like 0.2% is what I'm seeing?
Yeah, it can vary just depending on the bank. But I saw an interest-only investment loan recently, which was incredibly low sixes. So that's only 20 basis points more than what the people are paying for home loans.
Yeah.
And I've seen some people paying that for principal and interest loans. So just depending on how much you negotiate.
Yeah.
The next question is, how do I figure out the best suburb or area to invest in? And should I buy close to home or follow data and invest interstate?
Well, generally speaking, when you're investing, you're following data more than you are your emotion, aren't you?
Yeah.
So the whole close to home is fine as long as the data suggests that it's fine.
Yeah.
But there's also the diversification play. Well, there's an argument on both sides to say, well, I want my owner-occupier to be in this suburb where I live now. I can't afford that now, but I will buy something cheaper in this suburb to get exposure to that market should the market push. The problem with that is they're very different assets within the same market, and the housing market is an example of that. Well, that's shot ahead by 400 grand, but the unit market's only gone ahead by maybe 100 grand.
Yeah. So if someone said to you, how would I pick the best suburb to invest in? What would you say?
Well, we have this conversation in our office like daily. And I had one this morning with my team about this because it's so hot topic all the time. And with algorithms and AI and so much research and data at your fingertips really quickly, and so many subscriptions out there that you can get access to, as analysis paralysis. So, but the fundamentals, I think, will be the same in real estate as they are in any industry buying anything ever for the next 1,000 years. Supply versus demand. What's out there and how much do people want that? What's the asset that's going to be most popular and how many people are chasing that asset?
Yeah.
Now, I don't think there's any other criteria that trumps that. Do you think?
I don't think at all. And tenants are no different to owner-occupiers when they're looking for something to live in.
Yeah.
You still, if you want to live in that area and that suburb because it's got all those facilities, so are tenants.
Now, does the demand change because the area changes? Like, does an area generally improve or go backwards, right? Now, you and I was talking about a suburb this morning on the coast. That's probably an example that there's not many that's actually gone backwards, I think.
Yeah, that's right.
But a lot of suburbs, generally speaking, when they're old and run down, they gentrify, they improve because people see opportunity, don't they?
That's right.
Yeah, that's a big one for me is supply and demand. But all the other, I suppose, micro data points around that, like the infrastructure and your population and your economies and your vacancy rates and your unemployment and your owner-occupier versus investors. Like, I love that stat. How many owner-occupiers are there?
Yes.
Versus how many investors are there? And furthermore, how many owner-occupiers own their home outright, no debt? Right? Now, banks don't like those people because they're not a customer.
Yeah.
But the area loves those customers because they're not leaving that area because they've got disposable cash to spend where? Usually within that immediate economy. So, yeah, there's thousands, and as I said in the book earlier, like there's so much information around all of this in there. But the best, I think, there's more people coming to us saying, "I've researched till the cows come home, and now I need someone to straighten me up."
Yep.
More so than I don't know where to look, I don't know what data points to find. It's more the opposite now, which is interesting. What's more important, rental yield or capital growth? I was always told, and I still coach this today, is cash flow pays the bills, capital growth sets you free, gives you lifestyle opportunities. So I think that's runs true today in the sense that capital growth is the major focus point for most investors. And the example of it, shares and property, and Glenn and I have this debate every year. Shares is great for cash flow. Property is not awesome for cash flow because of the running expenses associated with it. But it's really important to understand that the cash or the property itself is not going to blow me up with lack of cash flow. So is this property portfolio going to generate $100K a year of positive cash flow for me? No, extremely hard to do that these days. But can it establish some really strong capital growth where my portfolio might double every 12 to 15 years in growth and I've leveraged the bank's money to do so? Absolutely. As long as it doesn't blow you up in the meantime through lack of cash flow, negative gearing.
Yeah, because we need to be able to hold them.
Absolutely. And when people have come from 2% to 6% interest rate rides, there's a lot of people who had to sell some of their portfolio.
Oh, absolutely.
All right, let's take a break. A bit of content there to consume. Let's go back. Let's come back and we'll talk about some things about, well, let's say new versus old.
This is Property is brought to you by Sphere Home Loans. Sphere Home Loans is a mortgage broker that helps our listeners all around Australia. So, if you want to get into your first home sooner, looking at upgrading, an additional property, or want your current mortgage reviewed, just search Sphere Home Loans or click the link in the show notes, and their dedicated brokers will be able to help you wherever you are. If you are, however, after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. That's moneypodcast.com.au and click Get Help.
All right, we're back. Rach has had a coughing fit and she's recovered, thankfully, because I can't do this on my own. We've got another story. Is it an anonymous story that we want to give again?
It is anonymous.
Yes. All right, let's play this story and then have a quick yarn about it.
Okay.
Hi guys, my name's Michael. I wanted to share with you our first property journey. My wife and I were living up in Brisbane, working in the CBD back in 2019, trying to get our foot in the door in the property market. And whilst we rented in the city and worked in the city, we were struggling to get a deposit and the funds together to get into the market. And so we had to look out in the suburbs a bit. We ended up having to choose a property about 45 minutes out of the CBD. And to get into the market, we really had to rely on the government incentives at the time, stamp duty concession, first home buyers grant. We needed to utilise those to get into the market. And we decided on a land and build package, a 4-bedroom house, 2 bathrooms, further out. And with the grants, in terms of eligibility, we had to make the call and bite the bullet to live in the property for 12 months and make it our principal place of residence. With that came a 45 minutes plus commute. Thankfully for us, we ended up finishing the build around the same time as in terms of getting into the market, it was a really tight struggle. We actually had to sort of wrangle with the cap limit that was in place for the stamp duty concession and first home buyers guide in terms of the property prices. And so we had to actually take some items out of our build contract just to fit underneath the limit or the threshold. Things like our fencing and landscaping, we did that post the build and sort of outside contract just so that we could squeeze in terms of eligibility. So at the end of the day, it all worked out really well. That property's already gone up around 200K. As fate would have it, we ended up getting a transfer for our work down to Melbourne, so that property is now an investment property for us. But the biggest learning for us is really to get into the market as early as possible. But at the end of the day, really happy that we went with our sort of preferred option of land and house as opposed to a unit. We were tossing up the idea of going with a unit, but the land value has gone up much more in comparison, and we're just very grateful to have gone down that path. And now we've got options available for our next property in terms of leveraging against that one to buy our next. That's our property journey. Thank you very much.
Great.
Very good. It wasn't anonymous. It was Michael.
It wasn't.
So what were your key takeaways from Michael's story?
Yeah, so my key takeaways were that they were looking to buy close into the city where they lived, and it just didn't work for them. So they've pivoted and gone with what they perceived to be a better investment, and it seems to have worked out for them.
Yeah, they were just using and abusing the first homeowner concession, weren't they? Really, which is what a lot of people did through that time.
That's
it's like,
right.
I've got this at my disposal. I'm going to knock all doors down to make this work, which means that they sacrificed their location and maybe their lifestyle to do that. They were like 40 or 45 minutes further out.
Yeah.
So, okay, I'm prepared to do that for a short period of time because I know I'm getting myself a better asset.
That's right. And just for the benefit of the listeners, what they're actually referring to when they were talking about the cap is a first homeowners grant, which they were in Queensland. There was a level, and I can't remember the level in 2019, but let's say for just a scenario that it was 600,000.
Yeah, I don't remember.
I can't remember what it was, but
Yeah.
let's say it was 600 for land and build. Well, if you bought a block of land for 300,000, your build contract couldn't have exceeded 300, or you wouldn't have got the grant. So they must have been somewhere near that cap. And they must have taken a few things out of contract just to scrape in to get that grant, because without it, it's a big difference in I guess they wouldn't have been able to even do it.
That's right.
By the sounds of things.
Yeah, so for reference to your example, you say, well, okay, I need to do the landscaping myself because I can't lend on that amount. I can't put a fence up. I'll do that myself once it's complete. Bits and pieces. And Michael, not alone in that sense. I heard a lot of investors had to do the same thing, or homeowners in inverted commas. So
that's right.
Yeah, very good. Good story. Interesting. They went land over the unit further in.
And it sounds like what they would have bought the unit, it sounds like for their own convenience.
Yeah.
Because they wouldn't have had to commute that 45 minutes. But when they discussed the difference in equity growth in that home in the last, what's going to be 6 years now, comparatively to what a unit, it doesn't sound like they have any regrets.
No, which is nice. Yeah, very good. All right, so which brings us to our next question, and it's that exactly. New or off the plan better than established property, or is that just developer marketing?
Oh, that sounds like it's in your wheelhouse.
Yes, but you've had some experience in both sides of that, haven't you? You've done both, and I've done both.
Yeah, I mean, I think they both have their advantages. I mean, there's a lot of risks with off the plan, I guess, that aren't there with something that's established. But as long as you understand what you're buying, there can be benefits for both. What are your thoughts? Yeah,
look, it definitely the supply-demand thing is there's more variables.
That's it.
Isn't there? When we come back to that key criteria of supply v demand, there's more variables because we don't know how many will be there at the end of the day. Like we know an apartment block, for example, they might build 120 in the complex. So we can do our numbers on that, but we don't know potentially what's going to be built around us as well in a new area, and then an urban area essentially. But the house and land space, a lot of that traditionally greenfield estates are further out in undeveloped areas. So again, we don't know exactly what's going to be built out there and when and what time frame and what the supply versus demand uptake will be and who are going to be our neighbours, owner-occupiers versus investors. So, yeah, you're right. There's a lot more variables in that new stuff versus the existing. I know the street. I know how many owner-occs there are. I know the schools. I know everything about it because it's been there 100 years.
Yeah, and if you are doing something, I guess, off the plan, just understanding all the fine print in those agreements. What are the time frames? What are the developers' rules? Can they, pull out at different times? Can they go over? Yeah. Just knowing all of those little details in the contracts too.
Yeah, and you're right. It's generally in their control, not so much the client. But yeah, the developer marketing, it's real, isn't it? It's definitely out there, and people are paid big money to talk exactly that.
Yeah.
So just be aware of that. Educate yourself and ask the right questions. But if I had to go somewhere, I would say established property for me.
I would probably go established too.
Would you?
Yeah.
That's interesting because you do like your new
stuff. I do like a few new ones. What are the upfront and ongoing costs I need to factor in beyond the deposit?
Yes. So the upfront cost, other than deposit, the obvious one is the stamp duty, isn't it? is I've got to factor that in. Different in every state, highest in Victoria, South Australia. Factor that in when I go in. The contracts, conveyancer costs, probably a couple of thousand in there. Your building and pest inspections, any due diligence costs associated with, is this going to be the right property for me? Buyer's agent fees.
Yeah.
All the initial costs to say, right, when we settle this property, how much does this cost me out of my pocket? And then we draw a line in the sand. From that day on, they're referred to as ongoing costs.
Yeah.
So the ongoing costs consistently, council rates, water rates, home and contents insurance, property management fees, they're probably your big ones, along with maybe repairs and maintenance that you'd allocate an amount for.
That's right. And if it is an investment property too, remembering that there is going to be a period of time at the start where the property is vacant because the property manager has to find a property, and then that first week's let fee. So just having a little bit of extra put aside to allow for that.
Yeah, that's right. And we brace our clients with this. Is the first month of owning the property, looks like my school report. It's pretty nasty. Like there's a whole lot of outgoings and not a lot of incomings in terms of the cash flow. So just brace yourself for that and just have your little buffers up your sleeve. But again, we say to clients, look, over that 12-month journey, in the first 12 months, how much will it cost you out of your pocket before you get any tax returns? Obviously talking investment here. How much will it cost you? If it's $1,000 a month, we've got to allocate $12,000 out of our future savings or already in our buffer accounts that we've allocated for through cash or equity. And then the tax refund is a benefit, or a bonus, sorry. So we're then putting that back into the pool of funds to start year 2.
That's right. How do I know if a property is positively or negatively geared and which is better for me?
Yeah, could spend a whole episode on this, and we may have to, Rach.
Yeah, I think we should.
I think we should. Now, paying tax is a privilege in Australia. It means our roads are good and our athletes go to compete and things like that. But I think it's a balance of tax being secondary to our overall strategy.
Yeah.
I don't want to see someone losing $20,000 a year just because their accountant says, I want to get you a juicier refund.
Yeah.
Essentially, it should be a secondary strategy. So should our property be positive or negatively geared is there's 2 parts to that. A, physically, can it be positively geared anyway? And B, do I want it to be? Right.
Yeah.
Now, we want our cake and eat it generally. So we'd say, well, if a property was going up by 8 to 10% a year and it was costing me nothing to hold, that's the dream property.
Fantastic.
Okay?
Unicorn property.
That's the unicorn property. But unfortunately, with 6% interest rates and the cost of property now, good property, versus the rental returns on them, we've got to expect some sort of negative gearing. Right? Now, that's not – I didn't design that. That's just the way it is in a lot of markets that we're looking in the moment. Right? If we want to go and search for positively geared property because our incomes are low, absolutely go for that. But just understand that they may be in small regional centres or they may be smaller dwellings, i.e. 1-bedroom studios, etc., because you're not paying for the land value.
Yeah, that's right. And I think when rates were a little bit lower, it was a much more regular conversation we had, which is should I have positive or negative?
Yeah.
But where rates sit right now, and that possibly, potentially, is going to change very shortly, where they sit right now, most of the properties are slightly, if not, somewhat negatively geared.
So I think which is better for me, it's more a case of asking yourself, what can I handle?
Yeah.
And then reverse engineer it from there.
But if someone was saying, I want to buy a positively geared property right now in a single industry mining town because it's got a great rent out somewhere right now, it might be positively geared, that probably isn't going to be a fabulous long-term investment.
Possibly not. A bit volatile. However, they might be a low-income earner, so they need the cash flow
right now.
So every situation is different. This is one really for an accountant, and we should always be chatting to our accountant before we buy, or at least before we sign a contract. What entity or structure should someone use? Now, in the lending world, you would have noticed, Rach, that all of a sudden the word trust has come in.
It's a lot. It's a big buzzword right now for us.
It's a very big buzzword. So I would say over my journey, 95% of investors would have invested in their personal name, 100% or 50-50 with their partner, etc., or 99-1 or whatever it might be. But talk to us briefly about the whole trust concept.
Yeah, see, we would always refer, if somebody asked me the question about structure, I would always refer them to the accountant. I really think that people need to get that advice not from anyone other than their accountant, because they can give all of the advice. And for you personally, I would say early in my career, more people use different structures. So I'm going back 18, 19 years ago, because the benefits were probably different back then. So a lot of people who said, oh, my parents said this. Well, the benefits for your parents might have been different to what they are now. I think a lot of people think they want to use a certain structure. Then when they actually go back to their accountant, they come back and say, actually, we're going to buy it in our personal name. But there are benefits to some different structures, and that would be a trust for certain borrowing reasons. And just to explain that briefly, it would be, if you were to, let's say, buy a property today and you bought it in a trust name, and then let's say that property's paying for itself in the trust, it's sitting over here, and then a number of years later you want to go and buy another property, well, that property here doesn't come into your borrowing capacity because you can get an accountant's letter saying, well, that washes its own face.
Whereas that wouldn't happen in their personal name.
If their personal name, that whole thing would have to come into borrowing capacity. So yes, there are some benefits for future borrowing capacity, but you really need to understand that fully with an accountant's advice before you start to consider it.
Yeah, and the trust is maybe a cool way to go if you're looking for asset protection or something like that. If you're open to litigation in your own industry or your own employment, that's a common way to go, isn't it?
Yeah, that's right. And we do have accountants recommend different reasons for different things, but that is the person to get that advice from.
Yeah, absolutely.
Here's another one. Do I need a buyer's agent, mortgage broker, accountant, or financial advisor, or is that all overkill? That's a lot.
It is a lot. I would say mortgage broker, absolutely. Accountant, absolutely. The other two, buyer's agent and financial advisor, weirdly enough, I'm a buyer's agent or run a buyer's agent company, but I also coach people on how to do it, right?
Yeah.
I'm quite passionate about, well, if people want to go and do it themselves, do it.
Yeah.
But make sure you're educated first and know what you're doing and have the confidence to go and do it and the time. If you haven't got that, you need a buyer's agent.
I agree.
I don't think there's anything in between. It's either go all in, educate yourself and go and do it, or outsource it to a professional who does it for a living.
A lot more people are using buyer's agents today than 10 years ago.
100%.
A lot more.
Yes, absolutely they are. Yeah, like buyer's agent 20 years ago wasn't even here.
Or it was for the elite.
Elitists who didn't want to know that they'd bought a property.
Yeah.
They didn't want anyone else to know that they'd bought a property.
What do you think for financial advisor?
Financial advisor is an interesting one. And hello to all the financial advisors listening here today. I would generally say no for property, but yes for financial wealth.
Yeah, and I think sometimes the financial advisor can be great, especially if somebody has one, because they're giving, they've probably got more than one strategy going at a time. But there's less, I guess, if you're buying your first property, do you need a financial advisor to advise you on that? No.
You've made that decision. And a lot of financial advisors, not the ones that sort of we deal with, but a lot of them aren't that pro-property. So that convolutes the message of me saying I want to go and buy myself an investment property.
I have had clients get that financial modelling done from a financial advisor, and I found that really interesting when they were buying investment properties.
Yeah.
Some of some financial advisors do that financial modelling, but I would say as a rule of thumb, probably not a necessary person.
Yeah, but in terms of like super and shares and planning outside of property, absolutely.
And protecting your wealth once you're buying them.
Your wealth,
if you're buying these properties, they have to be protected.
100%. Yeah. Okay. So I think that's probably all we've got time for today, Rach. In finishing, any final thoughts from you?
No, I thought those the client case studies were great. I thought I loved the future Airbnb potential of that first scenario. I love that he's already thinking about what's going to happen when he buys his forever home with this property.
Yeah, totally. The Airbnb future is interesting one, isn't it? It's sort of what's this space as to where it's going, but it's a nice byproduct of it for him, that's for sure. Yeah. All right. No, that's good. Thank you for thrashing that out with me today. Now, as I said at the start of the show, sort your property out and build your future. We do go into detail with that whole 8-point strategy, right? So if you're wanting to get some more information on that, the link will be in the show notes. I think that's a wrap from us. We really thank Terry Shear for supporting the podcast today. And I just need to say to you that it's been brought to you by Terry Shear, Australia's leading landlord insurance specialist. Whether it's damage caused by tenants, pets or loss of rent, their expert cover gives landlords peace of mind. With over 250,000 properties insured and a customer-first approach, they know what matters most when things go wrong. Find out more at terryshear.com.au. And remember, before buying this insurance issued by Terry Shear, read the PDS and TMD and consider whether it's right for you. See the website for a copy. Limits and exclusions apply. Terry and their team didn't say for me to say this, but I did get a reminder notice that my insurance with Terry Shear is due next week on one of our properties. So
do not forget that.
I will pay that on time, but yeah, I do endorse what they provide, generally speaking, with some of my property.
Amazing.
All right, Rach, that's been a wrap. We've been John and Rachel, and this is Property.
Any information given in this podcast is for entertainment purposes only, and you should seek your own property advice before acting on anything you may hear in this podcast. If you want to start or advance your property education journey, John Pidgeon's book, Sort Your Property Out and Build Your Future, is available where all good books are sold, or via the link in the podcast show notes. Opinions or comments from any guests on the podcast are theirs and not those of the hosts, the publisher, or their respective license holders.